Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Welcome back to the Finance Garage, the podcast that helps you make smarter money decisions without the jargon. As always, I'm your host, Jonathan Wu, Senior Financial Advisor and Principal at the SWU Group. And today we're diving into a question that hits nearly every Australian come tax time. Just a quick reminder to like, subscribe, and follow the Finance Garage podcast on your favorite platform. Right now, we are on Apple Podcasts as well as Spotify. Furthermore, we are now hosting our podcasts on the SWU Group YouTube channel. What's the difference between the Medicare Levy and the Medicare Levy Surcharge? Now, you might have seen both of them on your tax return and wondered why you're paying twice. So in this episode, we're going to break it down, what each one is, who pays it, how much, and more importantly, how to legally avoid paying more than you really have to. So let's start with the Medicare levy itself. Now, this is a 2% tax on your taxable income that nearly all working Australians pay. Now, it's not optional, and it helps fund the public healthcare system. So think about GP visits, public hospitals, emergency care, the things that make Medicare what it is. So, for example, if you earn $80,000 a year of taxable income, you'll automatically pay $1,600 or 2% as a Medicare levy. Now, there are exemptions or reductions available for some groups of people, which include low-income earners, seniors and pensioners, veterans, and some temporary residents. But for most of us, if you're earning above $30,000 or so, you're paying the full 2%. It's just built into your tax return. If we then flip over the other side and we look at the Medicare Levy Surcharge, or short form MLS, now this is where things get a little bit more spicy. This is actually an extra tax you pay on top of the Medicare levy if A, you earn above a certain income threshold, and B, you don't actually have private hospital insurance. Now, very specific about this, it's private hospital insurance. So we're going to come back and look at that a bit more in detail. The government introduced the Medicare Levy Surcharge to encourage higher income earners to take out private hospital cover to help ease pressure on the public system. So you're obviously asking, what are the thresholds? If you're a single person, if you earn over $93,000 per year, the MLS applies. If you're a family, the threshold is $186,000 and increases by $1,500 for each dependent child. Dependent child is defined by children under 18 or children that have special needs. And what's the surcharge rate? Well, the surcharge starts at 1%. And can go up to 1.5% for the top income brackets. So as a simple example, if you're earning $120,000 and don't have private hospital insurance, you'll get hit with the 2% Medicare levy, which is $2,400, and then a 1% MLS, which is $1,200, to bring a grand total of $3,600. So you can think about it as an expensive way to not have insurance. Before we go into some examples so that you can sort of line this up with your own personal circumstances, let's deal with some of the most common misunderstandings that we see in the market. So firstly, you may say, well, I already pay the Medicare levy, so why do I have to pay the surcharge too? Well, yes, great question. But the levy and the surcharge are in actual fact completely separate taxes. Everyone pays the 2% levy, that's just standard. But the surcharge is a penalty for high-income earners who don't have private hospital insurance. Another common question that we get is, well, isn't private health insurance itself optional? Well, technically, yes, it is. No one's ever going to force you to buy it. But if you're earning over the threshold and you don't have it, you'll have to pay the extra tax. It's a pay the tax or buy the cover system, right? So either way, you will be slugged with some sort of fee. And then that's where you, on an individual or a family or a couple basis, work out what's more optimum for you. Another question that we get is, well, I've got private health cover. I'm definitely safe, right? Well, not necessarily, because you actually have to look at the underlying cover that you have bought. A registered hospital policy that meets the government standards is the one that covers you to ensure that you don't pay the MLS. If you just take out an extras only plan with private health, and these are the ones that cover things like dental or physio, so what we call outpatient services, so ones that you don't get admitted into hospital for, well, these don't count. The super basic hospital plans might also not count either. So always check with your insurer whether or not the policy itself is MLS compliant. And the final most common question that we get is, can I just get the cheapest hospital cover and avoid the surcharge altogether? Well, yes, you can, and many actually do that. Some insurers even market these plans as MLS saver products. You might pay $800 to $1,000 a year in premiums, but save more than that on the surcharge. But just remember that these often come with higher excesses or limited coverage. Yes, you pay peanuts, you'll get monkeys. No surprises there. So don't expect first-class treatment when you come time to claim. So let's look at a couple of scenarios, and these might fit your own personal situation and allows you to understand the interaction between the surcharge and the levy and whether or not you need to reassess your own personal circumstances. So let's say Sam, in scenario one, and he's a single professional. He earns $120,000 a year with no private health insurance or no private hospital cover. So in his case, he pays the 2% levy, which is $2,400, and then pays a 1% surcharge for the MLS, which is $1,200, which brings it to a total of $3,600. Now, if Sam had a compliant hospital policy for $900, he would actually net save, regardless of taking, not taking into account whether he'd claim and the excesses that relate to that. He would actually save $300 because originally he needs to pay a 1% surcharge of $1,200 for the MLS because he doesn't have cover. But if he takes out a cover that costs $900, then the difference between the $900 and the $1,200, which is $300, is his net saving. The second example is Jane and Peter, and they're a family with a combined taxable income of $200,000. They're married, they've got a child, and so their threshold, including one dependent child, is $187,500. They have compliant hospital cover. So they would pay the Medicare levy, which in their case is $4,000, so 2% of $200, but they would pay no surcharge. So they avoid the extra tax and have private cover for their peace of mind. Now, we know the cost of living is getting higher and higher, and a lot of people are reassessing whether or not private health is important. Now, if you decide to cancel or continue to not take out that private health, then you start to understand that this Medicare levy surcharge actually grows along with you. And it also has implications. Even if you were to take out private hospital cover at some point in time, that period over the age of 30 where you didn't have it, also you would get penalized for that. So that's something that you should speak to your accountant about. Our third scenario is Auntie Linda, and she's actually a retiree. She's 68 years old with a taxable income of $28,000. She has no insurance, but she's firstly exempt from the Medicare levy because she doesn't have taxable income, or she's under that threshold. And she's also under the MLS threshold, so she pays no Medicare levy and pays no Medicare levy surcharge. So remember that not everyone pays both, and your income level is what's the most critical part. Then finally, we have Alex, who unfortunately missed the fine print when he was searching and purchasing insurance, and he earns $100,000 of taxable income in a year. But he only has an extras only policy from private health, and he missed the fine print in that he forgot that he needs to take out hospital cover, not extras only, from private health in order to avoid paying the surcharge. So he is not eligible for the surcharge exemption. On $100,000 of taxable income, he pays a 2% Medicare levy, which is $2,000, and then pays a 1% surcharge, which is $1,000. Had he bought hospital cover, he could have avoided the $1,000 surcharge. But depending on which type of cover he bought, he needs to assess whether or not that cover is more than $1,000 or less than $1,000, which would then work out his net position when working out if it's worthwhile to pay the surcharge or buy the insurance. So if we wrap this all up, remember that the Medicare levy is a 2% tax that most Australians pay to fund Medicare. The Medicare levy surcharge is an extra tax for higher earners without the right kind of private hospital insurance. And you can legally avoid the surcharge by buying qualifying hospital cover, often at a lower cost than the tax. Now, obviously, that cover, as I mentioned, would have higher excesses and less coverage overall. It is nonetheless, as long as it is MLS compliant, it qualifies as being hospital cover. So thanks again for listening to today's episode, and hope to see you all soon. I hope you enjoyed today's episode, and remember to like, subscribe, and follow the Finance Garage podcast on your favorite platform. Right now, we're on Apple Podcasts as well as Spotify. We're now also uploading our podcasts to the SWU Group YouTube channel, so you can also find us there. If you have any feedback or want to reach out to me for a meeting, you can always find me on all the socials, including LinkedIn, or you can email me directly at jonathan.wu@simonwu.com.au. And last but not least, remember to listen to the disclaimer after this, and we hope to see you at our next episode.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.